Next guest, who in his research believes that the strength of the bond market and its ability to predict a recession is a, quote, loaded question. Let's bring in Eugene Grinberg, co-founder and CEO of independent market data provider Solve. And Eugene, I want to go back to what Romaine was just showing us, how liquidity has dried up in the Treasury market, the absence of the government as a major player here and a source of demand. Talk a little bit about the inverted yield curve and what that signals at the moment, because it's been inverted for a long time, and we haven't seen recession yet.
Right. Thank you for having me. It's a pleasure to be here. The yield curve is quite inverted, right? So if you look at the near end of the curve, it's about 5%, right? So 3 months is at 5%. The 2 year is a little bit over 4, and then you look further out, right? We're looking at 3.5, 3.6%, right? So the bond market is flashing these signs of recession. Essentially, what the inverted yield curve implies is the fact that at some point in the midterm, likely towards the end of this year or beginning of next year, the Fed will have to start cutting rates pretty aggressively.
Okay, so the Fed is going to have to start cutting rates pretty aggressively. What is it going to look like before we get to that point? Because usually the inversion starts moving away right as we get closer to that actual point.
Yeah, so everyone seems to be on the same page, right? That we're due for another hike in May. And then it's a wait and see game, right? I think the concern with the Fed is not so much what's going to happen next, right? Is if what the Fed is trying to do is not working. If inflation proves stickier than it actually is, right? And they're not able to get inflation into that 2% target that they're desperately trying to get to, while we're seeing cracks in the economy at the same time.
Do you think the signals coming out of the bond market, meaning the pricing that we're getting, and more importantly the movements here, do you think that's an accurate reflection of that sentiment?
I do think it's accurate. I do find the equity markets to be a bit optimistic these days, right? I think the bond markets are spot on. It's widely believed that the bond markets are smarter. Not just because I've been in bond markets 20 years, but yes. So I do think that the bond markets are spot on.
And I raise that too. I mean, we know that underlying this, of course, the investors themselves, the people in the bond market, certainly have an incentive to be a little bit more on top of economic conditions. But there's been concern about the government not being there, being the buyer that it used to be. There's concerns here that with the lack of liquidity, you're getting these swings here that are being distorted by a couple of big fish that are just trying to, move their positions one way or another, and that's not necessarily a reflection of economic conditions.
Yeah, I mean, there are a number of concerns, right, that people believe still persist. The banking sector is one of them, right? So a lot of the people in the markets believe that SVB and Signature Bank are not one-offs, right? Especially as rates continue to climb, right? And which exacerbates sort of the longer-term asset problem that SVB had, right? Are there more chips to fall?
Okay.
So that's
are
been...
people trading around that? Are people just kind of moving to the sidelines?
I think it's been a lot of wait and see, right? So you actually see markets sort of moving sideways over the last couple of weeks, right? So I think it's absorbing a lot of the indicators that are coming out this week around banks. Some of the consumer-focused indicators that are coming out over the next couple of weeks. And most importantly, right, what is the Fed going to do in May?
Absolutely.
How about further down the road? We had tax day this week, and the government coffers are now $253 billion. So when you think about the debt ceiling and the standoff that is going to come in a couple of months, how are you thinking about whether that will come earlier as a result of the tax data that we got, at the same time that we're getting data showing that we're definitely moving towards a recession?
Yeah, I mean, that's the other thing, right, that's weighing on people's minds is the debt ceiling, right? If you look at the CDX and the CDS market, right, so the likelihood of default is quite high, right, which is scary to think about. So there's a ton of concern in the market these days.
So that also brings up an issue also of issuance. We talk about the Fed not being the buyer out there, but the Treasury, at least for right now, really can't be much of a seller, at least not to the extent that it would normally be.
Right, exactly.
Yeah, supply is definitely an issue here, right? What does supply look like when it comes to corporates?
So the market has been quite a two-sided market of late, right? But what has been playing out in the corporate space specifically, and frankly in the muni space as well, is that issuance has been quite low, right? With higher rates, issuers are not going to refinance their debt. So as a result, the activity in secondary markets has been healthy, right? And that's been sort of depressing yields. And so that has been playing out in the municipal bond markets as well.